Good morning, students. Yesterday we learned the meaning of business finance and why finance is required. Also, we recapitulated that the classification of business finance is in two categories. One is owners' funds and borrowed funds. Today we learn about three of the owners' funds. One is equity share, preference share, and retained earnings. Now let us see what do we mean by share capital. Capital obtained by issue of shares is called the share capital. Share means the share in the share capital of a company, and it includes stock. Person who holds a share in a company is known as a shareholder, and this gives the ownership right to the shareholder. Share capital is a part of owners' funds, and share capital can be divided into two categories: equity share capital, and second one is preference share capital. Equity share capital represents the real ownership of the company and is known as ownership capital or is a part of owners' funds. Few rights and features of equity shareholders, they are as follows. Equity shareholders enjoy risk and rewards of ownership as they are the real owners of a company. There is no fixed dividend. Dividend is a part of profit which is divided among the shareholders. So equity shareholders, they do not get fixed dividend, and the quantity of part of profit to be divided among the owners depends on the earnings of the company. Liability of the equity shareholders is limited to the extent of the capital contributed by them. Since they are the real owners in a company, so they have a right to participate in the management of the company. These shareholders are also called the residual owners since they receive what is left after settlement of all the claims of the company. That is, interest is to be paid to the for the loan amount, or any taxes are to be paid. Whatever leftover amount is there, that is given to the real owners of the company, divided among the real owners of the company, and therefore equity shareholders, they are also called the residual owners of the company. Employee stock option or equity shares, the option given to the directors, officers, or employees of a company or of its holding company or subsidiary company or companies, if any, which gives such directors, officers, or employees the benefit or right to purchase or to subscribe for the shares of a company at a future date at a predetermined price, that is known as employees stock option. That is, employees are given a part of ownership by providing them shares at a lesser rate. Now let us see what are the benefits of issuing equity shares by the company. First is equity shareholders, since they are the real owners of the company, so they become a part of permanent capital which is only repaid at the time of liquidation. Secondly, no financial burden is on equity shareholders. Since dividend payment is not compulsory on the company, there is no financial burden, fixed financial burden, because equity shareholders, they are given only a part of profit which is left over after making the payment to the payment of loans in the form of rate of interest or any other claims if required. Equity shareholders, issuing of equity shares is suitable for the investors, uh, that is the people who purchase the equity shares, they become the real owners of the company and they are willing to take the risks for higher returns. Liability of equity shareholders is limited, and that is limited to the extent of their capital contributed in the company. Shareholders gain from the appreciation in the value of shares, and there is no creation of any charge on fixed assets. Now, many a time students get confused regarding what do we mean by no creation of any charge on fixed assets. This means that for companies, if they require money and they are issuing equity shares for collection of funds, they are not required to keep any collateral like we take loan from the bank, since this is the ownership fund and this gives ownership right to the purchasers. So there is no such problem, there is no such creation of any charge on the fixed assets. Now let's switch over to the demerits or negative points of equity shareholders. Since shareholders are the real owners of the company, so they may not get profit every time. Fluctuating returns to the shareholders since dividend is not fixed. Cost of equity is higher than the cost of raising funds from any other source. Reason being that equity shares are costlier, and ownership is diluted once the equity shareholders are issued to the investors. Legal formalities laid down by the Security and Exchange Board of India, that is also required to be fulfilled in order to issue the equity shares in a company and to collect the funds through the equity shares. And also the unhealthy speculation in prices of shares during boom, officers of the company may indulge in speculation. So these are few of the demerits of issuing equity shares. Now we are switching over to the second source of ownership funds, that these are the preference shares. These the shareholders who purchase the preference shares, they also become the owners of the company, but they are not called the real owners of the company. They are those shares that enjoy a preferential position over equity shares with respect to claim of dividend or repayment of capital. Few of the rights and features of preference shares are: they carry a fixed rate of return, that is, they are not getting they get the fixed rate of dividend every time, and they are not the real owners of the company. Dividend is payable after profits, out of the profits which are after the tax, and at the discretion of the directors of the company. Shares generally do not carry any voting rights. So, equity shareholders are the real owners of the company, but preference shareholders are not the real owners of the company, and therefore they may not carry any voting rights, these preference shareholders, as they are not the real owners of the company. Some of the positive aspects of issuing preference shares are: they carry a fixed rate of return and safety of investment to the shareholders. Ownership rights are not diluted. They are not required to participate in the management of the company. So control is not diluted, and voting rights of equity shareholders, they do not decrease. And moreover, there is no creation of charge on fixed assets. Just like if required, we take loan from the bank, and bank requires many collateral and documentation. But if the companies require money to be collected through the preference shareholders, it is not required to create any charge on the fixed assets. Capital can be repaid as desired by the company, and there is no creation of charge on fixed assets, as I explained you earlier. Second is few of the limitations, that is negative points of issuing the preference shareholders. There is no assured return, since dividend paid only on the availability of profits. If profits are there, dividend would be repaid. If profits are not there, dividend would be accumulated for the coming years. uh, Preference shareholders, they dilute the claim of equity shareholders over the claim on assets of the company on liquidation. That is, at the time of liquidation or any such time when claims are to be settled, preference shareholders are given preference, and then equity shareholders get whatever is left over. Dividend rate is higher than the interest of on debentures, hence these are costly sources of finance. So debenture is a form of a loan, but preference share is form of the ownership right provided to the purchasers. So therefore dividend is a part of profit which is divided among the shareholders. This dividend is paid to the preference shareholders, and the rate of dividend is higher than the rate on debentures. Debentures we will discuss later on. Dividend paid is not tax deductible for the company, because this is paid out of the profits of the company. So there are no tax savings here, and this is not suitable for such investors who are interested in higher returns. Now, the third source of finance, that is the ownership funds, for third source is retained earnings. Portion of the net earnings which may be retained, which may be saved in the company for use in the future, they are called the retained earnings. They are also known as plowing back of profits. Availability of profit for plowing back depends upon the net profits of the company, then dividend policy of the company, moreover age of the organization, whether the company is an old company or it's a new company. Few merits of saving the money out of the profits, that is, few merits of retaining the earnings are: No finance costs such as interest is not required to be paid to anybody because these are the savings of the company. Dividend is not required to be paid because this is not diluting the control and we are not issuing any shares here, and it does not involve any flotation cost. Reason being that this is the company's saving. This is a permanent source of finance because this is not borrowed from also anybody. This has a greater degree of flexibility and operational freedom. It enhances the loss of absorbing capacity of the business. This also leads to increase in the market price of equity shares when it is properly invested. Now the last topic of today is limitations of retained earnings or savings the money through the profits. This causes dissatisfaction among the shareholders because if the company saves more, if it retains more of earning, it will pay less dividend to the shareholders. So this may cause dissatisfaction among the shareholders of the company. This is an uncertain source since profits are subject to fluctuations. Uh, Profits may be more, may be less. Company may sometimes incur abnormal profits, other time it may be suffering from losses. So this is an uncertain source because profits may not be fixed every year. These funds may not be optimally utilized by the management as they are the previous savings. So today we recapitulated three basic concepts, three parts of the ownership funds: equity shares, preference shares, and retained earnings. I hope you have all understood it properly. Revise it thoroughly so that you may further produce these as per the questions and you are able to solve the case studies depending upon the topics. Thank you all.